Okay, so for our illustration, okay, so we will use the problem for Blaze Boards Company. So here, they plan to sell 10,000 skateboards at 400 pesos each in the coming year. So the production costs include the following. Our direct materials per skateboard is 80. The direct labor per skateboard is 125. Variable overhead per skateboard is 15. And the total fixed factory overhead is 800,000. So it is also stated here in the additional information that a variable selling expense is a commission of 5% of price. Fixed selling and administrative expenses totaled 400,000. So the required uh, computation will be the following. That is, you're going to determine the letter A, how much will be the variable cost. Letter B, how much is our selling expense per unit? Okay. Letter C, what is the total variable cost per unit? Letter D, what is the contribution margin per unit? Letter E, what is the contribution margin ratio? Letter F, what is the total fixed expense for the year? And for the second requirement, you're going to prepare a contribution margin based income statement for the company for the coming year. And number three, so what if 13,000 instead of 10,000 boards could be manufactured and sold next year? So how would that affect the operating income and by how much? Okay, so for the solution, okay, for number one, letter A, so the variable product cost will include your direct materials, direct labor, and a variable overhead. So again, the requirement here is for you to compute for variable product cost. So we all know that when we say product cost, we will include only those manufacturing costs. So that is your materials, labor, and factory overhead. But in this case, we will only be including in our computation those which are variable in nature because the question is variable product cost per unit. So the answer will be 220 pesos. So you only have to add those items. Okay, for letter B, what about our selling expense? Okay, so it was mentioned earlier that our selling expense, which is variable also in nature, is equivalent to 5% of the price of the product. So that's why our selling expense per unit will be equal to 20 pesos. So all you have to do is to multiply it with 400 or its selling price. Okay, for letter C, so how about variable cost per unit? Okay, so please take note the difference between the question in letter A or the requirement in letter A and letter C. In letter A, you are required to determine variable product cost, while in requirement C, you are going to determine the variable cost per unit. So meaning to say, here we will determine the overall or the total cost per unit. So that's why what you're going to do is to add the answer or the variable product cost per unit with the selling price per unit. So when we say variable cost per unit, here we will include all the variable costs, may it be manufacturing or non-manufacturing variable cost. That is why you can notice that we added to the product cost the selling expense, which is considered to be a non-manufacturing expense. Okay, so what about letter D? So here in letter D, you are required to determine the contribution margin per unit or CM per unit. So here our formula to determine the contribution margin is to deduct from the price your variable cost, meaning selling price minus all the variable cost per unit. So the answer will be 160. Okay, next for uh, letter E. So in letter E, the requirement is for you to determine the total fixed expense. So this question or requirement is somewhat easy. What you're going to do is to only add all the fixed expenses mentioned in the data provided. So in our problem, so that's 1.2. Okay. So next, for the second requirement. So here we will determine, or you're going to solve or prepare the contribution margin based operating income or income statement. So please notice the difference with that of the typical income statements that we are preparing. Okay, so here, the format, of course, is very important. Part of the report is your heading, which will include the name of the company, the name of the report, and the period covered. So here, uh, if you could notice in the format, so we reflected the total amounts and the per unit, okay, value. So first, because we are preparing for income statement, so of course, the first item that should be included there is our sales revenue figure. So here, since our number of units sold is 10,000, so all you have to do is to multiply that with its price. Okay, so the total is 4 million. Per unit is 400. Next, under the contribution margin based operating income statement, uh, we will deduct from the sales revenue the total variable expense. Okay, so total variable expense will be based on the number of units sold as well. So in our previous requirement, we already determined the per unit total variable expense. So that's 240. So again, all you have to do is to multiply it with the number of units sold. Okay. Next, so under the contribution margin based operating income statement, uh, after we deduct the total variable expenses from the sales revenue, what we will get is your contribution margin. So earlier, if you have still remembered, we mentioned this formula. Again, to solve for contribution margin, all you have to do is to deduct from the sales revenue the total variable expense. So, in fact, in our previous requirement, we already determined that as 160 per unit. Okay, so after we derive the contribution margin figure, so the next step is to deduct the total fixed expenses. Okay, and the remaining balance will be our operating income. So what have you noticed with our format? So here, under the contribution margin based operating income statement, you can see that the costs or expenses were separated or categorized into variable and fixed expense. So this is what we actually been have been talking about in the introduction part of this module. Okay, so in CVP analysis, this is the reason why uh, determining or classifying the cost into fixed and variable cost is important because it is the requirement under this approach. Whereas, if you could still remember, in our typical income statement, um, our cost is just classified as manufacturing and non-manufacturing cost, regardless of its classification as to variable and fixed expense. So in our traditional income statement, our format is sales revenues minus cost of goods sold is equals to gross profit less your administrative and selling expenses and other costs. So that is equal to operating income. Okay, so you see the difference between the um, traditional income statement and our contribution margin based income statement. Okay, so I hope you were able to catch or follow the description which I have mentioned. You can also write that down in your notes to see the difference. Okay, for number 3 requirement. So here, you are required to solve for another uh, contribution margin because here, um, what if the number of units sold and produced will increase to 13,000? So in the solution in number 3, you could notice there that we just compute the incremental uh, figures, or we use the incremental approach. But you can also follow the format in number 2 requirement, meaning all you have to do is to change 10,000 into 13,000. We will also derive at the same answer in number 3. Okay? So in number 3, here, so as I mentioned earlier, we use the incremental approach. Okay, so only those increase in the number of units will be included in the analysis. So here, our increase in sales is 3,000. So that is from 10,000 units to 13,000. So again, we will just multiply it with the selling price. Next, we will also deduct those expenses that increased as our number of units increased. So meaning here, you will only be considering variable costs. Okay, so what happened? Our variable cost also increased. So 3,000 times 240. Okay. What about our fixed expenses or costs? What have you noticed? So it doesn't change. So again, this is the nature of fixed cost, meaning, as I have mentioned earlier, regardless of the changes, the increase or the decrease in the number of production or sales, fixed cost will still remain in the relevant range. Okay. So when we say relevant range, by the way, there is a certain level of number of units in which the fixed cost will remain fixed. For example, the amount of 1.8 total fixed cost will be fixed up to 20,000 units. What about if the units will increase to 25? So meaning our fixed cost will also increase. So in your cost control and or cost management and control course, you have learned there that if that is the case, then your fixed cost will now become mixed cost. So there is a part where it is fixed up to its relevant cost, and it will change or increase if the uh, number of units will also increase in excess of the relevant range. Okay, so going back with the solution, so our or the effect of the increase in the number of units sold and produced will be to increase also our operating income by 480,000. So again, you can use either the format presented in number 2, that is the total approach, or number 3, the incremental approach. We will still arrive at the same uh, answer. So the difference or the increase will be 480,000. Okay, so next is, okay, so equation. So here, what about the equation method for break even and target income? So the equation method for break even and target income is actually, this is where the companies frequently want to know how many units must be produced and sold to break even, as mentioned earlier, okay, to earn a target income. In other words, how many units will yield the desired based on break even profit. So the basic break even or target income equation can be derived from our um, formula in the contribution margin based operating income statement. So here, if you could notice, this is just the same as what we have presented earlier in the illustration. So your operating income is equal to sales revenues minus the variable expenses minus fixed expense. By the way, again, sales revenues minus variable expenses is equal to contribution margin. Contribution margin minus fixed expenses is your operating income. We just presented it in the other way around, okay, but it's still the same. So this operating income equation can be expanded. So if you could notice there in the slide, so we still have the same equation in the first one which is presented, but in the second equation we just expand it. So here, when we say sales revenue, that is the product of your price and number of units. Okay, so your variable expense is equal to variable cost per unit times the number of units. So total fixed cost is just total fixed cost. Okay, so next, okay, finally, the equation for the target profit is put in terms of units. So here, for the target profit, so our formula is, actually this one is derived here in this second form, in this second formula. So um, here, this is the break-even equation. Okay, so we will discuss first break-even equation. So to solve for break-even, as mentioned earlier, we have two types of break-even points. You can determine break-even point in units or break-even point in revenue. So in this presentation, the formula is for the break-even point in units. So, how to determine or solve break-even point in units? That is equal to total fixed cost divided by price minus variable cost per unit. Please take note that in this denominator right here, what is the resulting figure if we will deduct price, or if we will deduct variable cost, I mean, per unit with your price? The resulting figure will be your contribution margin per unit, or CM per unit. Okay, so again, in other terms, to solve for break-even in units, or break-even point in units, this is equal to total fixed cost divided by contribution margin per unit. Okay, so from this formula, we will now have this equation for the target profit. Okay, so here, what have you noticed with the formula with units for target profit? The same formula with break-even point, or break-even point in units. However, we just added in the numerator the target income. Okay, so that is why to solve for the units for a target profit, all you have to do is to add total fixed cost with your target income divided by your contribution margin per unit, or price minus variable cost per unit. So an important advantage of the operating income statement is that all further CVP equations are derived from the contribution margin based income statement. So as a result, any CVP problems can be solved by using also this approach. Okay, so we will have an illustration so that you will be able to uh, grasp the concept of what we have mentioned in the equation method. Okay, so again, we will use the same illustration in the first one that we presented. So here, for baseboards company still, so the same information. So here, the requirement is, number one, you're going to calculate the number of units so that the company must sell to break even. And you're going to prepare a contribution margin based income statement for the calculated units. So this is of course to determine and to check if that number of units indeed will give us break-even point. Number two, calculate the number of units the company must sell to achieve target operating income or profit of 240,000. And number three, so what if the company wanted to achieve a target operating income of 300,000? So would the number of skateboards be larger or smaller than the calculated in requirement number 2, and why? Okay, so for the solution. Okay, so here for the first requirement, so what is the break-even point in units? So again, using the formula that we have presented earlier, so again, break-even point is equal to total fixed cost divided by price minus variable cost, or CM per unit. So all you have to do is to use the data provided. Okay, so here for the company to break even, they have to sell 7,500 units. Okay, so next, so after you determine the break-even point in units, we will check if indeed if the company will sell 7,500 units we will have we will neither have uh, profit nor loss or at break even. Okay, so using the the contribution margin based approach for operating income statement. So here we have sales is 7.5 as computed in um, the break-even point in units. So multiply it with its um, selling price. Next, less variable expenses. So our variable expenses again is 240. Multiply that with the number of units to be sold. So your contribution margin is 1.2. And our operating or fixed expenses also is equal to 1.2. So therefore, your operating income is 0, meaning we have no profit nor loss. So this is the state of break-even point. Okay, so indeed, if the company will sell 7,500 units, it will yield into 0 of profit. Okay, so we go now to the second uh, requirement. So the second requirement is, what if the company desires for 240,000 target profit? So how many units should we sold or the company should sell? So here, again, using the formula that we have presented for uh, determining the target or desired profit. So that is total fixed cost plus your target profit divided by price minus unit variable cost or CM per unit. So again, using the data or the amounts from the data provided. So here, the company must sell 9,000 units so that they will be able to achieve or have 240,000 uh, income or profit. You can also check this one using the formula or preparing, I mean, the contribution margin approach operating income statement. So you will see there if you can use the illustration here in number one. All you have to do is just change 7,500 with 9,000. So there, after calculating, you will yield to 240,000 operating income. Okay, for the third requirement. So here, for what about if the company changed its mind and instead of 240, they desired to achieve 300,000? Okay, so basically and obviously, the company should sell more than 9,000 units so that they can achieve 300,000 desired profit. But how many units, to be exact, is that? Okay, based on our solution, they should sell 9,375 units. So again, you can also check this if this is correct using our contribution margin approach based approach in operating income statement. Okay, so next, what about uh, contribution margin approach? In the previous slide or in our earlier uh, discussion, we presented the equation method. What about using contribution margin approach? Okay, so here, this is a refinement of the equation approach. So the contribution margin approach simply recognizes that break-even point or the total contribution margin that is equal to the fixed expenses um, is indeed equal. Okay, so here the contribution margin is when we say contribution margin, again, just like what we have mentioned earlier, this is the difference between your revenue and total variable cost. Okay, so the formula is given. So number of units here. So to solve for the number of units, I mean for the break-even expression under the contribution margin approach. So our formula is number of units is equal to fixed cost divided by unit contribution margin. Again, this is just the same with that of the equation approach. However, we just shorten the denominator. So if you could still remember, in the equation approach, our denominator here is revenue or sales minus variable cost per unit, or that is again equal to contribution margin per unit. Okay, so they just presented it in another form, but it's still the same. Okay, so next is the break-even point and target uh, income in sales revenues. Okay, so here, to calculate the break-even point in sales revenue, the variable costs are defined as a percentage of sales rather than an amount of per unit sold. So again, we will use this concept because we are referring this time into sales revenues. Okay, so or in total. Uh, in the earlier or in the previous discussion, our or uh, the requirement I mean is for you to determine the break-even point in units. This time is for sales revenue. Okay, so here to express variable cost in terms of sales revenue, so the variable we will compute for the variable cost ratio. So what is variable cost ratio? This is the proportion of the sales peso that must be used to cover the variable cost. Or in other words, this is just the uh, all you have to do is to divide variable cost by sales revenue. Okay, that is our variable cost ratio. So here, the variable cost ratio can be computed either in total or in per unit. Well, again, the formula is just to divide variable cost with uh, sales or revenues. What about the contribution margin ratio? So the same also, this is the proportion of each sales peso available to cover fixed cost and provide for profit. Or this is also determined by dividing the contribution margin by the sales revenues. Okay, so here in the previous illustration, if the variable cost ratio is 60% of sales, so therefore, the remaining part of the sales, which is 40%, will be allocated or will be for our contribution margin ratio. Okay, so the proportion of sales revenue left after the variable costs are covered. So that is your contribution margin ratio. That's why we just only deduct 60% from 100%. So our 100% basis here is your sales revenue. Okay, so next, since there since there is revenue remaining after the variable costs are covered, it must be the revenue available to cover the fixed costs and profit. Okay, so if there is any. So in other words, we will compare the total fixed cost to the total contribution margin. So again, this discussion is related to the income statement, which is based on contribution margin approach that we have presented earlier. So here, if the total fixed cost is equal to contribution margin, So meaning the profit is equal to 0. So we are at break-even point. Okay. Next, if total fixed cost is less than the contribution margin. So meaning there is an excess for profit. So we will have a profit. What about if the total fixed cost is greater than the contribution margin? So this is just the opposite of the second state. So in this case, if the total fixed cost is greater than the contribution margin, meaning there is an operating loss. So while listening to this discussion, please try to look at the uh, formula or the format under the contribution margin approach so that you will understand better. Okay? So here we will consider the following, or the revenue, the sales revenue approach using the basic income statement. Okay, so here operating income. Again, this is the same as what we have presented earlier in or under the contribution margin approach. So sales minus variable cost minus total fixed costs. So this is just the expanded form. The second one is just the expanded form. Okay, and the third one is the same. Uh, by the way, this formula here, these first three formulas are just the same. However, uh, it was presented in different way because you can actually solve the operating income in or using these formulas. So here, uh, you can determine the variable cost by multiplying the variable in the second equation. I mean, you can determine the variable cost by multiplying variable cost ratio to sales and then did, uh, deduct that from sales together with your fixed cost to get the operating income. Okay, so the same also in the third one. So 1 is 100% minus variable cost ratio. 1 here represents sales. Okay, next. So in this next equation, so operating income is equal to sales contribution margin ratio minus total fixed cost. So again, the same in what we have presented in the income statement. So CM or contribution margin minus total fixed cost is equal to operating income. So if you could notice, in this formula right here, you don't need to determine the variable cost because um, we already deducted the variable cost from the total sales revenue. Okay, so again, I would like to reiterate, sales minus variable cost is equal to contribution margin. So here in this formula, we directly go to the contribution margin figure. Okay, and then deduct the total fixed cost to get the operating income. So at break-even point, operating income is equal to 0. So again, this is the same as what we have mentioned earlier. So break-even point is equal to, or here, I mean break-even point in sales or peso. So what we have earlier is break-even point in units. Okay, so here, to determine the break-even point in sales or peso, so the formula is still the same. Total fixed cost divided by contribution margin, this time is using the ratio. In the break-even point in units, we use the contribution margin per unit. Again, for break-even in sales or peso, our denominator is contribution margin ratio. So please take note of the difference. Okay? So to earn a targeted operating income, sales is equal to the sum of the total fixed cost and target income divided by the contribution margin ratio. So again, the same as what we have presented earlier. So however, this time, instead of using contribution margin unit per unit, we will use the contribution margin ratio. Okay, so to understand better, So we have here the following illustration. Okay, so for Blaze Company, again, so here they plan to sell 10,000 skateboards at 40 or 400 each in the coming year. So unit variable cost is equal to 240. Total fixed cost is 1.2. So the requirements are the following. Okay, number one, what is the contribution margin per unit? What is the contribution margin ratio? Calculate the sales revenue needed to break even. Calculate the sales revenue needed to achieve a target profit of 240. So number four, what if the company has targeted operating income or profit of 350? Would the sales revenue be larger or smaller than what we have calculated in requirement number three? Why and by how much? So for our solution, okay, so the contribution margin per unit, CM per unit is, okay, 160. What about contribution margin ratio? So again, all you have to do is to divide contribution margin per unit by the price or selling price. So we get 40%. Number two, break even in sales revenue or peso. So again, using the formula, so that's total fixed cost divided by contribution margin ratio. So here, to break even, meaning the company should reach 3 million sales revenues so that there will be no profit nor loss or at break even. Number three, so what if the company targets to uh, achieve 240,000 profit? So what is the target sales revenue? Okay, again, using the formula. So here, in order for the company to achieve 240,000 operating income, they must achieve or reach the total sales of 3.6 million. Okay, so because earlier in number 2, 3 million level of sales revenue is, or at that level, we do not have profit nor loss. So if you are going to increase it, so if you could notice this time, that's 3.6. Okay, in order for the company to achieve 240,000 uh, target or desired profit or revenue. Number 4, what if the company will desire 350,000 target profit? Okay, of course, uh, here the sales revenue needed would of course be larger by, okay, based on the solution, the new target um, sales revenues is equal to 3,875,000. Meaning here, if the company wants to achieve 350,000 operating income, they should have the sales figure of 3,875,000. So again, this is higher by 275 compared to number 3. Okay. Okay, so that is for uh, contribution margin approach.